Hi, good afternoon. Welcome to the marketplace. Coming up, Fitch Solutions projects Bank of Ghana will cut policy rate by 8 percentage points to 22% by the end of the year, a move that will stimulate private sector spending. Also coming up, government to open negotiations with Eurobond holders in London on Monday as it moves to restructure about $13 billion of debt. Plus, some cocoa bill holders who decided not to take part in government's cocoa bills exchange program demand full payment.
It's not been easy. It's not been easy. I've got a kid in school, in the university, and I have medical bills I have to take care of. I have the house I have to take care of, and it's not been easy.
My name is Daryl. Kwawu. Thanks for being with us. Details coming up. And thanks for staying with us. First up, the Bank of Ghana will embark upon a sizable monetary easing cycle, cutting the policy rate by a cumulative 800 basis points to 22% by the end of the year. That's forecast by Fitch Solutions. This, it says, follows a substantial moderation of headline inflation. Here's more in this report.
Since 2021, the Bank of Ghana has hiked the benchmark policy rate by 1,150 basis points to 30%. This has restricted access to corporate credit. But with inflation easing substantially, the central bank is expected to embark upon policy easing. However, Fitch Solutions said it usually takes about 12 months for interest rate adjustment to affect the real economy due to the lag in monetary transmission mechanisms. As such, the UK-based firm believes that the Bank of Ghana's dovish monetary policy stance is unlikely to result in a sharp increase in real loan growth, which has remained in contractionary territory over January to August last year. Meanwhile, the Monetary Policy Committee of the Bank of Ghana would hold its 116th regular meetings from Tuesday, January 23 to Friday, January 26 to review development in the economy.
Economist and research lead at GCB Capital, Courage Booty, is on Zoom with us. Good afternoon to you, Courage. What are the chances that this happens? What would it take to get to 22% by the end of the year?
Oh, good afternoon to your listeners. Yes, naturally, the monetary tightening that we saw, the aggressive tightening, was in response to inflation. And it was one of the ways to try to bring inflation down. If you tighten the liquidity channels, you mop up excess liquidity from the system, you stop deficit financing, and the fiscal authority also exercises restraint. All of these combined, plus the effect of base effect and a number of other factors, CD stable, petroleum prices and cost pressures easing in general, we would have succeeded in bringing inflation down. And that is exactly what happened. And so naturally, with cost of credit so high and growth depressed, it's expected that if inflation starts behaving properly, you would see monetary policy rate also ease to try to stimulate growth. So it's not out of place, that focus. They are looking at 800 basis point decline this year. My personal projection is about 600 basis point to about 24% thereabout by end of the year, starting from May. And the reason is that, yes, inflation may have receded to 22 points, I believe 23.2% now, all the way from some 54% at the start of last year. But then we still have risk to inflation. You could see the volatility in the month-to-month inflations, and you could see the fact that we are in election year and expenditure pressures in the election year, if any at all, could pose risk. We see development in the Middle East and its potential impact on oil supply and by extension prices on the market. We are not completely out of the inflation troubles yet, even if it's receded significantly. And for the month January, February, my expectation is that yes, it will decline, but at very marginal rate. And there could be a reversal in the trend even in March before it ultimately returns to the disinflation path. With that kind of uncertainty surrounding that, there may be volatility from March before the ultimate disinflation process declines. I think the Bank of Ghana will want to exercise caution and they will hold the rate this month, potentially in March also, just to see how actual inflation turns out. And of course, to observe the trend in the core as well. I expect the core to keep declining. We haven't seen the rate for, I think, November, December. It will come, I believe, when they release the data, and we expect it to be declining, but still above the headline, really. And we need to look at what is driving that. So I expect they will start maybe the dovish stance or shift the monetary policy stance from May thereabout, and I expect about 600 basis point cut by end of year to 24%.
I mean, Fitch Solutions in this analysis said it usually takes 12 months for interest rate adjustments to affect the real economy due to a lag in monetary transmission mechanisms. As such, he believes that the Bank of Ghana's dovish monetary policy stance is unlikely to result in a sharp increase in real loan growth, which it says has remained in contractionary territory over January to August. Your take on that analysis as well?
Well, beyond the trends, there's the 12-month trend Fitch is talking about. The reality facing us is that yes, macros may have been improving, but the operating environment is still very much aligned. The country risk are still there. The negative ratings are still there. And with such challenge operational environment, banks who are now in the process of trying to recapitalize from the ravages of DDEP and how it impacted their capital, the last thing they want to do is to be aggressive on loans to sectors they consider risky or are exposed to the economic cycle. And for that reason, you may not even see aggressive growth, even if interest rates decline sufficiently. And again, of course, Fitch argument may be coming from the fact that once loans are expensive, the risk of defaults are higher. And so naturally, and interest rate don't recede sharply because policy rate is coming down. It's a gradual process. I believe where that is where they are coming from. And I agree to that to a very large extent. But the operating environment as things are now, even if interest rates drop to maybe a 20, 25%, even overnight, it may not automatically result in aggressive growth in the loan book because the operating environment is still very much aligned. The recovery we've seen is a fragile one. It is not entrenched yet, and there are still substantial risks to the outlook. It all depends on how we sustain the program and the reforms under the program to ensure that we build in irreversibility. And until those concerns are fully addressed, I don't think banks in the mode of recapitalizing or shoring up their capital will be so keen on advancing loans. Maybe if we complement any such policy rate actions with drastic declines in T-bill rates, where they are getting closer to where we knew they should have been or they should be, then maybe there may be the motivation to look at a loan book as a way of sustaining profits. But other than that, for as long as stable rates as high as they are, yeah, there may not be very sharp declines in or there may not be sharper growth in loans for the period.
All right. And so the Monetary Policy Committee will hold its first meeting for the year next week. Are we going to see a downward review in the policy rate? Do you anticipate because of the decline in inflation? Because there are also some analysts who think it is too early and would be a knee-jerk reaction.
It is too early. It is too early, and it may even contradict the Bank of Ghana's stance, themselves, that we need to hold rates for longer to try to anchor disinflation. And I alluded in my first, the response to the first question that, yes, inflation may have receded, but there is still some substantial growth risk to that outlook. Election is one. Development in the global market is another. The CD is still very much vulnerable to shocks, even if we expect some inflows to show up the reserves and things like that. So it just pays that we stay a bit patient and ensure that inflation is firmly anchored. And I think we will start thinking about rate cut when inflation is around 20%. Currently, it's 23.2. Uh, when it's around 20%, getting into the 19s and 18s, I think that would be a good case for bringing down the policy rate. There may have been positive real monetary policy rate now, but then it should have been the case for a long time. Now we've returned there. We need to sustain that for a while to anchor inflation expectations sustainably. So I think January is too early. Even March, because of the noise I expect around inflation in March, even March, I think they will still hold the rate and probably look to the first cut in May.
And finally, also next week, government is expected to formally open negotiations with Eurobond holders and commercial creditors in London. The engagement will target institutional investors who are holding these financial instruments. Government is seeking to restructure about $13 billion worth of debts, is also proposing up to 40% interest rate cut. How do you expect negotiations to go?
To be a tough one.
What the finance minister says will be a tough one.
40% haircut is a big one, but I guess the background work has been done. The negotiations did not start today. They have been going on, I think, since we completed domestic debt restructuring. In fact, they went on alongside. And so the offshore commercial investors, Eurobond investors, are pretty much aware what government's thought are. Again, they are aware of what the debt sustainability thresholds are and what needed to be done to restore debt sustainability. And again, they will be minded by what the official creditors have granted government and what the gap is to do that. So I believe that is a contest. Hopefully we get a deal that works and satisfy the conditions. That will mean that we are restoring debt sustainability, because there's no point in restructuring external debt if it won't give us the debt sustainability we want. And there are thresholds. There are amounts that need to be forgiven and written off and stuff like that before we could get to that restore debt sustainability. So I'm think they are aware of those parameters, and the conversations will center around there. It will be a tough take to get a 40% haircut, but if that is what it will require, I guess they will have conversations around it. We may not get very easy conclusions, but definitely we'll get something that works.
We'll be following. Thank you so much, Courage Buti, Research Lead, GCP Capital. I appreciate your insights as always.
My pleasure.
Now, turning to other news, some cocoa bill holders who decided not to take part in government's cocoa bill exchange program are asking Cocoa Board to honor payment before the close of January. They say the inability of government to pay them their monies is affecting their livelihoods. James Ishan visited the Kwawu family and comes through with this report.
January 2023, monies paid to investors who purchased cocoa on maturity were in individual investors' accounts without their consent. Cocoa Board issued the bill to raise funds. Many had bought the bills expecting to be paid back their monies with interest on Thursday, January 19, 2023. Reports from some fund managers indicated the monies were actually paid on Thursday, January 19, 2023, only to be reversed on Friday, January 20, 2023. The banks have pointed to a directive from the Bank of Ghana ordering them to unilaterally roll over the bonds without first seeking the consent of investors. Banks were under pressure from affected customers. Kwawu, a retiree, was one of the affected customers. He expresses shock at the development since the money was rolled over without his consent.
I worked for 36 years. I started at GB Olivant and then went to Unilever. Then I went to Unilever in Zimbabwe. Then I came back to Guinness in Ghana, worked for a short time. Then as for the investments, one can say I've been investing for a while. Treasury bills, fixed deposits and all those things. And it's only recently that we took the cocoa bills.
6 months after the Ghana Cocoa Board launched a debt securities exchange program, under which it invited holders of its short-term debt securities or the cocoa bills to voluntarily offer to exchange their cocoa bills, Cocoa Bills holders were asked to sign on to the exchange program, but Echikwam opted out.
As part of my retirement, I got a certain amount and I put it there. If we were in another place, and then they came and made another proposal to us, which was interesting. So we moved our funds there. And we were supposed to enjoy our benefit plus our initial capital in January 20. Yeah, that was in 2001. 2023, yeah, 2023. So we were waiting. Then we had some hints that something was up. So we wrote to them and said, look, sell our thing and give us back our investment. Okay. And they said they would try. So come the payment time, I saw that the money had been credited to our account in the morning. Before I could say Jack, it had been debited again. So we were rather surprised. And apparently this debt recovery program had been launched. So we didn't know what was going on.
Almost 6 months after, no communication on the payment for those who decided not to tender. Echikwam and wife, amongst others, are worried why government and Cocoa Board are failing to honor payment of those who failed to tender their cocoa bills after government pegged the participation in the exchange program at 97%, with over 7 billion Ghana cedis bills tendered.
We have been extremely successful with the current tendering of more than 90% for cocoa bills of 7.9 billion cedis and US dollar exchange of $809 million. And detailed announcements will flow through when the settlements are done.
According to Gifty Kwam, wife of Echikwam, footing the bills of their ward in the university has been very difficult.
I think it's morally wrong. And in fact, it's legally unacceptable, you know. I mean, the trauma even to our children who have to even go through all kinds of things and explanations. It's not right because they know their parents and they know we planned for them, you know. So I'm begging the ministry to pay us our money. That's all. It's our money. You rolled it over without our consent and with your own interest rates. Fine. You give us our money back. Give it to us. That's all we're asking. It's not right to.
All right, you're watching The Marketplace. Turning to the Joy Business Advisory Series. Today's topic is on working capital management from the SME perspective. Samuel Bechi is Senior Manager, Accounting Advisory Services at KPMG. He's in the studio with me to take a look at this. Welcome to The Marketplace. I want us to start with the definition of what working capital is for the benefit of our audience.
Thank you. So working capital management happens to be a capital that every company needs to start a business. When you start a business, you need to fund the operation. So the money that you need to fund daily activities or operational activities is what we call working capital. But to go a step further, when we talk of working capital management, what we are then talking about is to try the process of optimizing the company's current assets and current liabilities in order to maximize operational efficiency.
I mean, you talk about maximizing operational efficiency. Talk to us a bit more about why this is relevant for SMEs.
So the essence of the working capital is so crucial that if you don't have working capital in place, the business will not be able to pay debts, cannot be able to pay expenses, cannot be able to pay even wages and salaries when they fall due. So the essence of working capital is so crucial that you need it. It's like having a vehicle and no fuel. You can't go. In the same way, human being without blood, there is no way you can move about. Therefore, working capital is so essential that regardless of whatever you are doing, you have to ensure that you have it in place.
All right. And so what are the components of a working capital management, for instance, and how can SMEs embrace them?
So working capital, as I've already defined it, we have a number of components. One, current assets. A current asset, as the word is defined, current, all assets that you are able to convert to cash within 1 year. An example includes inventories or stocks, receivables or debts, your cash. If you have even prepayment, because it's your money which is with somebody else, and receivables. So these are the current assets. Then the current liabilities are payables, accounts payables, if you have a loan that are payable within 1 year, or expenses that you have to pay within 1 year. These are current liabilities. Now, you need to establish the difference between this current assets and then current liabilities. In the essence is that the current assets should be able to fund the current liabilities. And if possible, you should have money outstanding in the event that when opportunity raises its head, you have available funds to make.
Yeah, I'm going to ask you about, some of the challenges that affect the effective working capital management. But again, just for the benefit of our audience, what are the sources of working capital? How do people generate working capital? For instance, if somebody wanted to start a business.
To start a business, you need capital. But once you are in the business, you need to sell goods. That is inventories. You need to sell. Once you sell, you need to sell on credit unless you get cash. But if you sell on credit, then those people become your debtors, therefore accounts receivables. You can give them maybe credit period, maybe 1 month, 2 months, depending the policy that the organization as an SME you have. Based on that, then you'll be able to collect them. So you must be able to ensure that you have funds available. If you are giving inventories out, and when you are getting the money back, it should be shorter in such a way that you'll be able to get money, even if you are buying additional inventories, right, you can buy them on time. And all the time you should have available.
Yeah, I ask because, usually when you engage SMEs, once they raise money to start a business, then they get stuck along the way because they are not able to manage their working capital well. They don't know how to generate income to keep the business going. And then it's like they come to a standstill and then the business runs into a ditch. And so tell us about some of the challenges that stifle effective working capital management.
So because of what you just said, let me make a response to that, sure, then I'll definitely come to the challenges.
Yeah.
Therefore, we need to establish the difference between initial capital that any SME, when you are starting a business, you start with, and then the working capital. So when you start a business, you may need money from a friend, or you might have your own money that you are starting the business with, and that is the capital. That you start with if you're a small business. If you're a company, it can be called seated capital that you start a business with. But once you are in the business and you are operating on daily basis, you need money to fund whatever you are doing.
And that's what people don't really think about. They only think about the money to start, right?
Exactly. And as a result, when money comes, they use it for any other purpose without actually using it to fund what is supposed to be in the organization.
Okay, so let's deal with the challenges that affect the effective management of a working capital.
So there are a number of them, and I'll put them in 3 baskets. One, limited access to capital. Because they are SMEs, they will not be able to raise capital on stock exchange and other big marketplaces. They result in using friends' money or limited funds. Again, because they have limited funds and they are SMEs, they don't have track records that suppliers or banks can leverage or rely on to give them money if they want. And that has been a challenge. Even those that the big suppliers, when they are giving them money, because they don't have that capacity, they try to squeeze them. Another one has to be with fluctuations, seasonal fluctuations, because the SMEs, at times, they can have a lot of demand. At times, the demand will go down. And when that happens, it affects how they do things. If you cast your mind back, even to COVID era, there are a number of SMEs that were not be able to operate because there were no business. Demand went down drastically.
Yeah. Yeah.
So then the next one also happened to be dependence on fewer suppliers and customers. When you have one or limited supplier, whatever the supplier says, that's what you do.
Okay.
And the limited, customers. And when there is a change in demand, or when the customer changes, moves from you, it becomes a challenge for you.
So we'll conclude because we have just a minute. Just give us some of the strategies that can help us effectively manage our working capital.
So I'll divide the strategy into two. One, general strategy and maybe specific strategy. One, if you are managing your working capital, you should have a policy in place.
Okay.
And you should assign roles and responsibilities to people who you are assigning to.
Okay.
Then they should ensure that the policies are being operationalized. Now, as I spoke about components of working capital management, so the strategy should be also aligned to each of them. So if you pick inventory, because of time, so if you pick inventory, you make sure that you assess the credit worthiness of your customers before you give it out.
We are going to continue this conversation tomorrow because you are coming back. We are going to explore it further so that people will have to understand, so we don't have to rush it through. But thank you so much, Samuel Birchie. He is
Stephen Birchie.
Stephen Birchie. I'm sorry about that, Stephen Birchie. He is Senior Manager, Accounting Advisory Services at KPMG. I appreciate your time with us. More news on our website, myjournalline.com/business. You can read more about the Finance Minister's visit to London next week to engage Eurobond holders. My name is Daryl Kwawu. Thanks for watching. We'll be back same time tomorrow.